Today, we're taking a look at 5 critical questions every home buyer should ask when trying to get pre-approved for a mortgage. Of course, the Bank of Canada announced a 0.5% reduction in the key interest rate this week, and buyers have already started coming off the sidelines, getting ready to make a purchase. My name is Dana Gain. I'm a broker with Right at Home Realty. Let's get right to it. Unlocking your mortgage pre-approval. What are the 5 most important questions every home buyer should be asking? Now, of course, we are used to being the ones that are asked the questions by the bank. They want lots of documents and they have a lot of questions about income and all these kinds of things. But I also think it's important for home buyers to be ready with their own questions, because someone can come back to you with a pre-approval, but there may be things that it's not taking into consideration that will have an impact on how much you can actually spend. Question number 1: has your mortgage advisor asked you for documentation to support the pre-approval? Now, I see some of these 30-second mortgage pre-approval ads or get approved in 5 minutes. This is not necessarily to be relied upon. What you're looking for is for your lender to be asking you for documents first and foremost. They'll be looking for an employment letter, tax returns for the past 2 or 3 years, notices of assessment from the CRA. They're going to want identification from you. They will want to know how much of a down payment that you have to contribute. And then they take all that information back and they make a determination about how much you're approved for in terms of buying a house. If you've not been asked for documents and subsequently sent them and had them reviewed, it's likely that your pre-approval is not necessarily to be trusted. If, on the other hand, your mortgage advisor has asked you for a list of documents, you have sent them, you've waited 2 or 3 days or maybe a little bit longer, and they've come back to you and said, here's how much you're pre-approved for, that's a number that I would be inclined to believe. Question number 2: was there any condo fee included or taken into consideration when calculating your pre-approval? So, for example, if you're looking at a condo apartment or a condo townhouse, understanding that condo is a type of ownership and comes with a fee, a monthly fee, I'm sure you've noticed that condo fees range rather dramatically. You can have a condo fee of $100 per month. I've seen condo fees upwards of $1,100 per month. So, as you can imagine, that's a big extra debt for a homeowner to carry. So, if your bank has taken a condo fee into consideration, which you hope they have if they know that you're shopping for a condo, then you want to know what that number is. Did you assume $500 a month? Did you assume $300 a month? And so on. Knowing how much of a condo fee has been included in the pre-approval will tell you if the number they've given you, let's say, for example, it's 600,000, that's what you're approved to buy. If a condo fee has been taken into consideration, then you can feel good about that. If a condo fee has not been taken into consideration, then it's likely that your actual money to spend will be less. Question number 3: what property taxes were included in your pre-approval calculations? This is important because property taxes are not all created equal. We have Halton region with Oakville, Burlington, and Milton with very, very low property taxes. And then as soon as you go west into Kitchener, Waterloo, you've got Brantford, places like Hamilton Municipality, all of those areas, the property taxes are much, much higher. So, what are the property taxes that have been taken into consideration when calculating your mortgage? That's a very important question. You want to make sure that based on where you're shopping, that number is realistic. Question number 4: how long is your amortization? Amortization just means the period of time scheduled to pay off the mortgage. It's usually 25 years. It can be as much as 30 years in some situations, but knowing how long you have to pay off the mortgage will impact the amount that you're paying every month or biweekly. It will also impact the amount of the payment that goes into equity, which is essentially the part that you keep. So, as a result, knowing how long it is you have been given to pay off the mortgage has implications for a lot of different reasons. And finally, question 5: has your mortgage advisor looked into both 25 and 30-year amortizations for you? If you're close to the limit of what you can afford payment wise, it could be possible to extend the amortization, say from a standard 25 to a slightly longer 30 years, thereby reducing your payment amounts. Now, this is important because it has implications on both sides. If your mortgage pre-approval right now is a 25-year amortization, you could potentially have access to a larger budget by extending the amortization to 30 years. That's the good news. The not so good news is when you extend your amortization, in other words, you take longer to schedule the mortgage payoff, that means that in the early years of that mortgage, a lot more of that money is going to interest and a lot less of it is going to principal. And principal, of course, which is your equity, that's the part that you keep. So make sure your mortgage advisor is taking a look at both 25 and 30-year amortizations. This will apply if you have an insured mortgage, but it will also apply if you do not need an insured mortgage. In other words, you have 20% or more to put down. There are some lenders that do offer 30-year amortization. So regardless of which school you fall into, which bucket, you should have access to both 25 and 30-year amortizations. My name is Dana Gain. I'm a broker with Right at Home Realty. If you have any questions about what you've seen today, please feel free to reach out and send me an email, give me a call, or send a text. Thanks again for watching and see you next time.